Welcome to Investors Hangout once again. Every week we talk to you about something which is top of your mind, investment issues, your anxieties, and try and answer as many of your questions. Today we are going to talk about how to invest for your goals, how to formulate a strategy or an investment plan for your goals. And today we have a very special guest, Mr. K.S. Rao. He has organized and conducted 5,000 investor education interactions. He has been able to connect with or responsible for connecting with 4 million, 40 lakh investors in this country. He is responsible for the educational initiative, investor education initiative at Birla Sun Life Mutual Fund. And for 25 years, he has been an industry veteran, worked through companies. And today I have invited him primarily to talk about, just to understand that how Indian investors are evolving. What are the questions that they are asking now? What are the questions they had before? What are the questions they had 5 years back? And what is the kind of change that he sees? Are these change positive, negative? So welcome Mr. Rao to Investors Hangout. Mr. Rao is as much a contributor to the to happening of this Investor Hangout thing. He has been a great encouragement in bringing this episode of educational initiative to you every week as well. So Mr. Rao, my first question to you is, how have Indian investors changed? What are the kind of questions they're asking now? What they used to ask few years back and what they used to ask many years back?
Okay. Thanks Dhiren, thanks for being me on Investor Hangouts at 69th episode.
Yeah.
And it's I could see the 69 episodes going itself is we are evolving over a period of time. And Indian investor is definitely on a phase of evolving. I look at if not very past, and the last 5 years story. 5 years back, when investor is looking at to invest, probably is looking at one of the products, or he got some lump sum money he want to invest. There is an avenue to look at. And today he is evolving in such a way, he has gone to a disciplined mode of investing, and most of them the way they are coming into the investment in the mutual funds, thanks to the industry campaign from Mutual Funds IEI or the fund houses, the campaign, the way we run together is evolving to them that like today we have little over 2 crores investors coming to the SIP every month. I mean, like every month there will be around 20 to 26 lakhs people who are joining in this mission, but we have a 2 crores plus of SIP accounts in the fund. And that way he is committed to make his investments in a disciplined way. I look at most of these investments, they are coming as a regular process and discipline. And I also hope some of them, they are linking these SIPs which they are investing with their respective financial goals. And that's probably they have seen, probably they understood the risk thanks to the mission you created and the way you work, and thanks to the value research from the beginning, the way you are educating the people, and the whole campaign is culminating into people to come and look, I need to invest regularly, I have financial goals.
You have conducted so many sessions and you have had so many connect with individual investors. Which is the most, if you have to list in priority, any investment goal which, what investors ask for, what are they planning for, what is their priority, which is the most popular goal for which they want to invest?
Okay, it's very interesting, and probably we have divided by the regions but united by the goals. And it's the best part when I can look at is the predominant goal for everyone is making their children education. Or
planning for
the child education, or planning for the child's marriage, which will be a later part of the time. It's either of this. And as you are aware, we have an interesting initiative which we are running at this point of time called Fauji Nivesh, and we call Fauji Nivesh camps. We go to the regiments, and these are the Faujis who are helping the nation. It's protecting the nation, and we thought it's where to we go and serve. And what I could see over a period of time in the Nivesh camps is 4 out of 5 Javans, they say children education is the primary goal for them.
Primary goal.
And one other initiative which you are part and you are the keynote speaker, which is our Nivesh Mahakumbh, where we do take the we propagate financial goals through a tool called Smart Selfie, which I remember you inaugurated in our Guwahati Mahakumbh.
I got my own Smart Selfie too.
Yeah, so, this is a fantastic tool where I get to know what are my financial goals, and I pledge my financial goal.
Let me just explain what is Smart Selfie here. At this Mahakumbh, a lot of investors turn up in a city, and everybody is taken to a camera with an iPad, and one is forced to think about, one is asked questions about how old are you, who are your children, your dependents and other things. So 3-4 pieces of information. But at the same time, you are asked about your goal, that what do you want to save for. And I have seen investors coming, standing there, and they get into thinking, because many investors don't think about goal when they are investing. Many investors think that they need to invest, but they don't think about what they are investing for. And that is when they start thinking in terms of, okay, this is something which is 15 years away, this is something which is 10 years away, this is something which is 3 years away. It actually brings about a methodical framework of thinking about their investments. And once they have provide this information, your information is stored, you are sent an email, you are sent a reminder once in a while that are you doing something about this goal, and then you carry back a picture with your family with these goals printed on it.
Yeah, this is a fantastic tool, as you rightly said. It's a tool to provoke you. What are your goals? Most of the times we do invest, but we do not know what for we are investing and why we are investing. Probably this tool or the thinking of why is coming through evolving the financial goal. And the first is, what is my goal and who can help you to reach my goal? It could be my financial advisor, it could be my financial planner. And the second is how I can reach that goal and when I have to reach my goal. And this whole process can get there. And even in the Nivesh Mahakumbh, the statistics shows to me today 70% of them predominantly look at their investment for the children education or children marriage. The second best goal is coming is how I can retire rich.
Okay.
And the third goal, planning for the retirement. Then the third one which is coming is either buying a house or planning for a vacation.
Okay. So
these three are the predominant goals. But one area which I got a very different approach which I could see from the people, it is a generation to generation. Probably this is one kind of generation who are 30 and above who are looking at these goals, but who are less than 30, who are the youngest or the young and Gen Next, they look at their goals are either it is a short term or it could be a medium term. And their goals are also very different, and like we do conduct the program called Fiscal Fitness workshops for the corporates, and when we go these youngsters, their immediate goal could be when their next adventure plan where they want to invest for it, or their adventure trip. And the second best they talk to us is they want to develop their skills and they want to go for their higher education in some university. I mean, maybe a 2 years, 3 years.
Which is the funniest question which you have got from youngsters in any of these camps?
Oh, fantastic! I think I can recall not on this fiscal fitness workshops, but I have a module called My First Paycheck for the final year graduates.
Okay.
It is in one of the universities in western part of the country. When we went, do you have any fund which can help me to have my mobile replacement every 2 years?
Okay.
He wants a mobile replacement fund.
Yeah, and maybe at that stage, that age, that is the most important thing he has to spend on. Yeah,
it's very interesting, and of course people can always look at their financial goals very differently. Now you have various tools available to accomplish their financial goals. What else? Just think what is your goal? List down your goals, write down your goals. I was reading somewhere, the moment you think of your goals and writing down your goals, there is a possibility of your accomplishing is 80 to 90%. It is like, I mean, I was also there in Banaras in one of those initiatives where Prime Minister was launching Sankalp Se Siddhi. Probably, once you have Sankalp, that goal you made it and it will have an accomplishment. I mean, what do you suggest, Dhiren? When I go to these people, they feel these goals are very long term, it's very difficult to accomplish. What is that we need to suggest? Since you are there for over a period of 25 years and you address many people, what is that advise us how we can make them to get their goals done?
Well, I've been thinking about it, and I've been thinking about it for my own children, that how to initiate them to think about investments, and I find it very difficult. But I would still say that it is in somebody who is very young, it is very difficult for him to think of 20 years, 25 years, and maybe their context is very different from the kind of context we grew up in. So they are relatively well off, more confident or whatever, as compared to, we lived in a very starved economy where we had to wait for everything and we were fine with it. We were very patient people, patient generation, because everything came with a waiting. So maybe they are different people, but I think, some basics don't change. One is that what can be had with money, you need money for that, and you need more money. Inflation is going to exist, will prevail. I would not like to work very hard on in terms of educating them about long-term investing, this, that, but educating about compounding. And somehow if they become a small saver and they are somehow able to dodged into investing, that is good enough, because then all the education happens on the go. Once you see that, okay, my 500 rupee went there and it became 700 rupees in 3 years time because you ignored it, because you did not spend it, that itself will take care of it. Because I think this is an age where the consumption is so dominant, you have so many avenues of spending, and that it's very hard for somebody to resist those temptation. Anyway, we are so anti-investment, anti-savings, that investment comes later. So if somebody is somehow initiated into savings and investment in a small way, SIP, even if somebody is dodged into, okay, this is your mobile replacement investment, and 2 years you will be able to upgrade your mobile. If that promotes, if that provokes him to start investing, that is good enough, because he would have understood the trick.
I'm sure, he will not only understand the trick after 2 years, it is a hard-earned money which he saved and which has got compounded. Probably he may not like to replace his mobile, probably will continue.
And he will understand the value of it, or the unnecessary, if it is not necessary to change his mobile, he will not change it. So, the value of money will be far more appreciated. Otherwise, your life situations itself can be a big teacher over time. And it is so dynamic that, your parents will get old and they need to be treated, and, you will have your own, everybody will have his own circumstances. But I have, one question which was crossing my mind, that, you have been part of this AMFI's educational initiative, you have been part of that investor education committee. And AMFI has done a great deal in terms of creating awareness with the mutual fund Sahi Hai campaign. But they also have a website and they have very interesting tools. What about the tool which helps you plan things for a goal?
Yeah, one has to just go back to mutualfundsia.com and you can see your goals. It can be done, what is your goals, and there's an inflation calculator, there's a goal calculator. At Aditya Birla Sun Life, we have launched one initiative. So I think, for us, as a goal planning, we have taken as an approach way back, and we thought it's a goal planning is the most important. We call it the Sabse Important Plan, and we have a SIP Now Sabse Important Plan, and SIP Now at adityabirla.com, which is a website where somebody can go, with financial planner or with, where you can do your goals, and your goal is being calculated and your inflation adjusted, and what is the returns you are expecting. Then you can identify how much amount you need it. It is a simple way. And in this area, we have done one more approach to propagate goal planning. We find it is the best way to invest. We have created in the country today 10,000 goal planners certified by one of the leading financial academy, and we do the practicing workshops for these financial planners who help the investors on accomplishing their financial goals.
Okay, this is where I would like to just supplement it with what was coming to my mind while using any tool for goal planning, is that a lot of investors send their questions to Value Research for doing their financial planning, and I have looked at many of these questions. We try and answer, we try and provide a outline of a plan in every issue of our magazine, Mutual Fund Insight. But one thing which comes to my mind, and which I see in every question, is that people have been able to articulate what they need, their goals, that daughter's wedding, child's education, retirement in this year, building the house, or renovation, or a holiday plan in retirement, and all that. But everybody's mindset, and everybody is also aware about the inflation, but they are unable to adjust the spending needs. If somebody thinks that today it will cost 10 lakh rupees for my daughter's wedding, then even 10-15 years from now they think that it will cost 15 lakh rupees only. We are constant about our spending, even though everybody has appreciated, because all these things are so dynamic, they all change. So it will be useful for you just to play with these goal planning tools, so that you have a general sense of how urgent it is. Because many a times if you think that 10 lakh rupees is good enough and that is what the target you have set, and or for your son's education or daughter's education, if you have thought that it will cost you 40 lakh rupees, things can be dramatically different if you don't factor the inflation. So play around with these tools. It will sensitize you about the real the real goal that the real financial goal that you should set yourself for.
I think you brought one important concept here, therein, on the taking the inflation. And inflation on two ways it's working against the people. The one area which you mentioned, but the other area I look at is when people are retiring. Most of them, they are not their post retirement needs, like my regular monthly income, which they, when they are investing, they plan very methodically. I have X amount of money which I got today, my superannuation, and I need this money every month. But the problem comes to them when as they grow. I mean, the expenses are growing up, and they live much more longer, and their expenses are growing up, and that money what they earmarket is not sufficient. Either they need, I need your guidance, how you advise such kind of investors, where they need to change the approach. I think they need to move from the traditional savings, or they need to take some risk, or they need to invest in a better way, or they need to recapitulate their entire investment plan.
Oh, this is one of the most important question, and in fact the most popular question which we are getting at Value Research, and we try and address it in every alternate investor hangout. I think just to reinforce the whole concept, because this is a need which has been accelerated by two things. One is that most investors historically thought that if you are conservative, you have saved enough, put your money in fixed deposit, safe return will take you through. No longer. Interest rates are coming down, and they will go down further. Even though it has gone up by 25 basis point last year, it doesn't matter. It is not going to make a difference to your income level. So interest rates will come down. It has brought down your income. You have to assume risk. How much risk should you assume? And you have to create a hierarchy of your income requirement, because there is a definite income requirement, the money that you need for, so you will have to plan it a little carefully. The money that you necessarily need every month for a comfortable living, which you are used to. Do you have any source of income, whether it be a pension or an annuity, or a house for which you get a rental income, a regular income for yourself? If you have that, fine. So you have to really provide for that. Invest that much amount in a fixed income fund or senior citizen savings scheme or post office MIP for the guaranteed return bit. Rest of the money you have to you need to work towards supplementing your income. Supplementing your less periodic income is a different thing, but at the same time, with your investment plan, you have to provide for ensuring that you do not run the risk of outliving your savings in your lifetime. Because if you have just enough money, all the income produced from that money is consumed. It's a problem, because 5 years from now that money will not be enough. 10 years from now that money will be grossly inadequate. So you should work in a manner, you just might have to plan reducing your, you'll have to plan to reduce your consumption needs in the initial years while you are still okay, because your future needs will only get complicated with health needs and other, healthcare and other things going up. That apart, so we have devised a rudimentary formula for you, assuming that you have no pension, nothing, but you have to, whatever capital you have accumulated for your retirement income, if you invest in something which is hybrid, whether it be a balanced fund or a conservative balanced fund or a balanced fund or a equity income fund, which can have a maximum of 25% depending on your risk tolerance and the amount of money that you have. If your withdrawal rate of investment is 6%, you will be okay. Because if your annual withdrawal, and I'll cite you with I'll just give you an example for ease of understanding. Assuming that you have 1 crore of rupees, just for crore not as a precise amount that you should have, but just for ease of calculation, Assuming that you have 1 crore of rupees of savings in your retirement, and if you take 6 lakh rupees out of it, which is 50,000 rupees a month, when you do it by way of withdrawal plan, not from the dividend plan or not from in any other means. If you set up a withdrawal plan of 50,000 rupees from a 1 crore investment in an equity income fund or a balanced fund or any of these, so there is a likelihood that your 50,000 rupee income every month can be upgraded to something like 52,000 rupees a year from now, because next year your 1 crore rupee after this 6 lakh rupee withdrawal has the potential to become 1 crore 5 lakh rupees or 1 crore 10 lakh rupees, and 6% of 1 crore 10 lakh rupee is your inflation adjusted. So your capital is growing, which can support a higher income, and that is the simplest way. 5 to 6% withdrawal rate, 5% if you are in a very conservative thing. That doesn't mean that you are generating 5%. You are leaving a part of the return generated to support higher income for yourself in future. So this is the simplest model that you can follow. It is also very tax efficient, because in the initial years, the money that you take by way of withdrawal is only a very small component will be gains. So, and the tax levied on that, even if it is 15%, because the gain component of your withdrawals will be so low, that it will be nothing. So you have to really work on your income plan very seriously. You need careful planning, you need simplicity. You can do it with 1 or 2 investments, and understanding these concepts and developing a belief in this is crucial.
I think I fully agree with you, Dhiren. I mean, you have well summarized. One need to look systematic withdrawal plan as an option at the mutual funds for their retirement positioning, and withdraw lesser than what you're earning, so that your capital get appreciated, and over a period your corpus is getting bigger and bigger, rather than taking out from the corpus. Corpus is earning for you. Well said.
Now I'm moving to, for this episode we have got a set of questions, so I'll be asking this, just listing these questions. Venkat has this question: SEBI has carved out a category for retirement and children funds. What's special about them? The special thing about them is that they are being called one. So when investors invest, these funds are primarily meant for the naive investors who will look at these investments with they will look at these investments for these goals in a very sacrosanct way. They will not fiddle with it. Because if it's for the children, then it will be invested, and of course these are very simple ordinary funds. They are conservative hybrid funds, or they are aggressive hybrid funds for these 2 goals. There is no special, of course SEBI mandates that both these funds must have a lock-in period, so to enforce this. So we have to see how it evolves. But any mutual fund can be your retirement fund. Any mutual fund can be your children's fund. And in fact, if you are a little thoughtful, and if you are listening to Investors Hangout, you better be choosing the best fund for these goals, because depending on the time frame for your investment, assuming that you are 30-year-old and your retirement is 30 years away from now, then you should be entirely into equity as possible. Only in a limited way you should be in fixed income, to the extent the money that you need for emergencies, or the money that you need for spending in the next 2-3 years, and you should just have an allocation to fixed income for rebalancing. As you get closer to your goal, you should turn conservative. My sense is that if somebody has been a lifetime investor in equity, he will not have to turn conservative, because in 20-30 years time you will learn that equity is volatile, but volatility is not risky, is not risk. It is wild, it is volatile. So you should tame that volatility with your asset allocation. You should rebalance it periodically. You should have a small fixed income allocation when you have a lot of time. Likewise for your children's education. If you are investing for 18 years, be as much into equity. As your child gets ready to get into college, be reasonably into fixed income for his first year's college fee. While he is in first year, prepare your redemptions for his second year fee. So plan accordingly. Any fund, any good fund, could be a retirement fund or a children's fund. Another popular question, which is from Arvind: how can I select fund for goals spread over 5 to 10 years? Any equity fund will do the job, and be into equity for 5 years, And after that, as you get closer to your goal, it is important that two things which matters while investing for the long run, and particularly for a goal, that as you are working on an accumulation plan, most investors should do a regular investments to accumulate their savings. One should avoid one-time investment, and it is as much important that you work on a methodical withdrawal plan, because depending on the market, for one big spending for all your life, many years of savings, be dependent on the market for your goals is a very risky idea. So think of a situation that you are investing from something like 1998 to 2008 for a certain goal.
Yeah.
And you were waiting for the last day that, okay, December 2008 you will take your money out for that big spending, whatever it be. That will not be fair to you. Maybe such important goals, when you have such sizable such accumulation for a large spending plan, you should work methodically. Start your withdrawal 3 years before you need the money, or maybe 1.5 years before you need the money. So you will be reasonably assured your child's education cannot be dependent on the market. You better be prepared for it. So work methodically on a withdrawal plan, and 1 year before you need the money, that money should be in your fixed income fund or your bank account. So withdrawal plan and appropriate fund for this, and an accumulation strategy, and mutual fund and diversification, which comes guaranteed with a mutual fund. So rest of the things will be taken care of. Here is a question which is about Shreya is asking when and how one should decide if it is time to exit a fund. You shouldn't be asking this question to me, because only you have the answer. As I was telling you that you should plan your exit before you need the money, depending on the non-negotiability of the need. You should plan it. So it should not be dependent on the state of the market. Most investors have this question that market is expensive, it has gone up or it has gone down, should I run away, should I take my money out, should I take my profit? That's the biggest problem, is that if you take your money out, getting into the market once again gets very difficult. Markets are very unpredictable. I have seen a state of the market from 2004 to 2008, when investors, in 2004, they took out because the market went up from 2,800 to 4,000. After they took the money out, the market went up from 4,000 to 6,000. Then getting in became very difficult. Then on an interim correction, somebody invested, and then they got tired. Then they invested again at 7,000, and then the market went up to 10,000, and then went up all the way to 20,000 without much of a time frame. So 2004 to 2008, the big move in the market, and investors who were jumping in and out of it because they were getting scared or they were getting greedy, and they were trying to ask this question, and they were executing those based on what they thought was the right. It turned out to be a disaster. So when investing in equity, you make sure that you are investing the money which you don't need for 5-10 years. You are investing regularly. And even if you are faced with a correction, it will be a good thing if you have these two things in place. Never invest lump sum. So it will all be automatically taken care of. And before you need the money, plan your exit. So that is the long answer to your very short question which you're asking. Anup has this question that I retired last month. Is it the right time to invest my PF money in debt funds in lump sum? What would be the right type of fund to invest in 20 lakh rupees? Anup, you need some careful planning. Will you be getting pension? Do you need to depend on this investment for your income need, regular income need, or it is just a long-term fund? If it is a long-term fund, then my advice will be something different. If you are going to depend on this money for periodic regular income and every month, then you need to think differently. So talk to a financial advisor. He will understand your needs, or maybe share more details about yourself, that what is your requirement, because it entirely depends. One question which a part of your question which I can answer is that we keep suggesting that invest regularly. Invest regularly is valid for equity fund, not necessary for fixed income, because equity is a very volatile asset class and every investor should avoid the possibility of catching a market high. Fixed income funds, you don't need to worry. You can invest lump sum in a debt fund. So the next question I'm taking is Dr. Das. Is it a good idea to book profit in 1-2 years time when the markets are high while still continue your SIPs? No, don't do this. Don't do this gymnastics, because we don't know. You have a full control on your investment time frame. You have a absolute, you are the best person who has the understanding that when you are likely to need the money. You are the best person who knows how safe is your job. You are the best person who can think that how your income will rise and how much money you will save, because you know your circumstances best. Your children are getting out of college, they will land into a job, suddenly you will have substantial surplus. You have built your house, your EMI is coming to an end, from next month you will have more savings to be made. So you know your cash flows best, and be guided by these things which is in your control and you have full understanding. Markets, nobody knows. All we know is that markets go up over time. Whether they go up or down in a very short time frame, we don't know. Last 5 months, have amply demonstrated that markets could be very risky for the short run. But despite that, if you are asking this question because the market is going up and down very widely, don't miss one particular picture, that over the last 10 years or over the last 20 years, even the Sensex, which has been beaten by many mutual funds by a wide margin, has been able to generate nearly 15-16% annualized return. Yeah. In the last, look at last year itself. The small cap funds gave a return of nearly 60%. The mid cap funds gave a return of 45%. The multi cap funds, the fund which is reasonably diversified, I keep suggesting they should be the mainstream vehicle. They went up by 35%. So if you invested a year ago, your 100 rupee became 135, and in the last 5 months of this volatility, you have lost 5%. If you have lost 5%, of course it hurts to think that your money which became 135, now it is down by 6.5 rupees. But don't lose the big picture. Keep investing through the lean times and don't take your money out. It amounts to timing. One situation when you should take a part of your money out is when you have set an asset allocation for yourself. If you have decided that your money should be 50% into equity and 50% in debt, and you need to rebalance because the equity went up substantially or fixed income went up substantially. Absolutely. That is the time you should take a part of equity or debt depending on the asset allocation which you have set out to be. Rebalancing should drive your exit from equity or not based on your thinking that the market is very richly valued, very expensive, and it will be wise to take your money off.
So therein, if you can look at those previous 5 questions coming from the investors, is it not the theme which you started today, the goal-based investment? If that is the case, these questions will not arise.
Yes.
And if I am marrying with my goal and staying invested, and I am linking my SIP to the respective goal, and when I need to exit doesn't arise, it is only my goal arrives, then I need to get out.
Yes, absolutely. If you get goal focused, you will not be asking this question, and we will be answering some other questions that you will send. But I would like to just summarize it, that there is one thing. There are many investors. Of course, investors are asking this. You are asking these questions entirely because in the past we have invested that, and we have witnessed that markets go up and they go down and they don't recover very quickly. But get focused on a goal. But there are many investors who actually tell me that they don't have a goal, and the whole idea is to maximize the return. Even maximizing the return, then investing in equity is a general bet on economy. If the world is going to be better, if the good businesses are going to be better, bigger, more profitable, they will be creating different kind of services, different kind of things, and they will be earning profit. And equity is the only way where the companies are able to grow their earnings in an inflation adjusted way. So stay focused. Don't try to time the market. Devise your rule, follow it, and investing for the long run can also be a goal. Then your goal should be to maximizing your return. Absolutely. And being regular about it, disciplined about it is the only favor that you can do to yourself. Thank you, Mr. Rao, for sharing your insights about your interaction with investors, these large number of investors over years with us. And we look forward to seeing you sometime once again.
Thank you so much, Devin.
Thank you all for being with us.